Have you ever wondered if the biggest driver of economic growth could be the thing that also causes the next big market crash? Right now, Wall Street is buzzing about something called an AI bubble. Some analysts think this wave of artificial intelligence spending could keep the economy growing, while others worry it might crash markets and slow things down. Today, I'll explain why this matters for the US economy in 2026 and why investors are watching it so closely. Stay with me, because what you're about to hear could change how you think about investing, jobs, inflation, and the future of the economy. Big technology companies in the US are spending an enormous amount on AI infrastructure, chips, data centers, and software, far more than ever before. This surge in spending is one of the main reasons the stock market has hit record highs this year. But here's the twist. Even though these companies are investing billions, profits aren't growing at the same pace as the spending. That makes some investors nervous that prices in the market may be going up too fast without enough real earnings to back them up. When that happens, many worry we could be seeing the early stages of an investment bubble, similar in mindset to the dot-com era, but with artificial intelligence at the center. Some economists say this AI investment boom is actually supporting overall economic growth. They point to strong business spending and consumer demand that have kept the US economy resilient. Companies are pouring money into innovation, and that has helped boost productivity and expectations of future profits. The International Monetary Fund has even raised its forecast for global growth in 2026, largely because of strong investment activity in technology and AI around the world. But there's also a risk that if investor confidence weakens or earnings slow down, stock prices could fall rapidly, creating instability. Another big piece of the puzzle is inflation and interest rates. Inflation is still above the Federal Reserve's target level, and the Fed's decisions about when to cut or raise interest rates will play a huge role in shaping the economy. If inflation stays high, rate cuts may be delayed or reduced, which could make borrowing more expensive for businesses and consumers. That, in turn, might slow down spending and hiring. At the same time, some economists think that the productivity gains from AI could eventually help lower prices and give the Fed room to ease monetary policy, but that outcome is far from guaranteed. Many top economists disagree on how quickly productivity improvements will show up in the numbers. This environment also affects the job market. Early signs suggest that while hiring will continue, it might be slower than in past years. Worker demand in some sectors could soften as automation and AI change how companies operate. Slower job growth could reduce wage increases, and that might cool consumer spending, one of the main engines of the US economy. On the positive side, consumer spending remains relatively strong for now, which helps sustain growth even if other parts of the economy are weak. Looking ahead, some forecasts show moderate economic growth in 2026, supported by continued tech investment and resilient consumer activity. Others warn that if AI spending fails to deliver the expected returns, or if inflation stays stubbornly high, markets and the broader economy could face increased volatility. What this means for you and other investors is that it's important to understand both the upside and downside scenarios. The future could hold continued expansion and innovation, but there's also a real chance of market corrections and sharper economic adjustments if fundamentals don't keep up with expectations. Thank you so much for watching. If you found this video helpful and want more economic insights like this, please hit the like button and subscribe to Economy Brief so you don't miss our future updates. I really appreciate your support, and I'll see you in the next video.